Hey guys, welcome to EIKV and this is Vishnu. So in this illustration, Good Luck Limited has been enjoying a substantial net cash inflow and unit the surplus fund are needed to be meet tax and dividend payments and to finance for the capital expenditure in several months time. There have been invested in a small portfolio of short-term equity investment. So they have given the table containing the companies A, B, C, and D. Number of shares which would be 60,000, 80,000, 1 lakh, and 1 lakh 25,000. Beta 1.2, 2.3, 0.8, and 1.28. Market price 4.9, 2.93, 2.17, and 3.17. Latest dividend would be in percentage 6.4, 3.4, 5.7 and 3.3. Expected return would be 19.5, 24, 17.5 and 23. The current market return is 19% a year and the risk-free rate would be 11%. And you are required number one, on the basis of the data given, calculate the risk of Good Luck Limited short-term investment portfolio related to that of the market. Number two, recommend with the reason whether the Good Luck Limited should change the composition of the portfolio. So going ahead with the solution, first of all we need to find the return. For the computation of return we need beta. So beta for individual company has been given. So we need to convert the beta into weighted average beta to get the entire beta of the portfolio. Therefore statement showing computation of weighted beta, it would be the company first column A, B, C and D, number of shares as given in the question, then we have beta, then market price has been given. When we multiply the market price with the total number of units in hand, we will get the market value. After that the market value should be total, the total value should be 11 lakh 500. Then we need to divide the 11 lakh 500 with each of the market value of the share to get the weight. After getting the weight, we need to multiply the weights with the beta and taking the total we will get the total beta. So the total beta would be 139.3012, 1.393012. So after getting the weighted beta, you can compute the CAPM return. So here we have four companies starting from A to ending from D. So beta would be 1.2, 2.3, 0.85 and 1.28. So we need to compute those things with the beta. So compute the CAPM return. So the CAPM formula would be RF plus beta into RM minus RF. While computing these formula in each company, we will get the return. So the return in percentage would be 20.5, 29.4, 17.8 and 21.24. But the expected return would be 19.5, 24, 17.5 and 23. So from here we can find that the expected beta as given in the question. So when we compare the return which we have computed through CAPM and expected return which we have given, we need to analyze whether to buy or sell the decision. So if the expected return is lesser than the actual return, we need to sell the position. So in the first three situations, the expected beta is much lesser than the CAPM return. But in fourth scenario, it is vice versa. That is, the CAPM return is lesser than the expected return. So in first scenario we need to sell that which is also called overpriced, and in fourth scenario which is underpriced, so we can buy those funds. So guys, thanks for watching this video. I hope you're clear with this example. If you find this video helpful, please subscribe.